All right. Well, welcome everybody. Welcome to the next in our series of Lunch and Learns. Today, the title of our show is called Uncharted Waters, and I'm really looking forward to today's presentation. We have two of our advisors. We have Francois Giguere and Marla Mason, two certified financial planners that are going to be talking about some of the uncertainties and things like that that are in the world today and how those might be affecting your thoughts and the investment world. For those of you that are not familiar with A&I Financial Services, we are a firm located in the southeast part of Denver. And what we'd like to do and what our mission is to serve a select small number of successful families, help them grow and protect their investments, and let them choose how they want to be taxed. So with that, I'm going to turn it over to our team and let them give you their insight into what's going on in the investment world in this uncertain times. Guys, why don't you take it away?
Thank you, Bret. My name is Francois Giguere, and Marla and I are excited to be making this presentation for you guys. Hopefully you will enjoy. So what elements make up these uncharted waters? We will look at what our experts believe will impact the economy as we exit this period of COVID and our economy reopens more fully over these upcoming months. We will also spend a little bit of time looking at changes implemented last year with the Secure Act and how it affects you moving forward. Lastly, what does the new administration say are its goals, and how do our experts believe this will impact the economy and your portfolios? Marla and I want to bring an approach to these questions that is not political, but look at it as investors and financial advisors and see how we and our portfolio managers can position our portfolios to help you navigate these uncharted waters. I will now turn this over to Marla.
Thank you, Francois. So when we look back at where we've been in 2020, I think a lot of us here on the call and around the world we're looking forward to 2021 and saying, this has got to be a better year. And it certainly, if nothing else, has come in with a very large bang. And so just in this last 5 to 6 weeks since the start of the year, we've seen rises in COVID cases, vaccines, deaths. We're now over 400,000 deaths in the United States. We saw on January 6th an attack on the Capitol. We've had tech giants trying to silence some of people on social media, high-profile individuals. We inaugurated our first female Black vice president on the 20th, and we now have sworn in a Democratic Senate and House into our legislature. We have another impeachment trial, which is going on right now. And we had some market gyrations as a result of excessive short interest selling and with Robinhood and the problems with various stocks like GameStop. And so this has been nothing short than of a totally unique, uncharted waters year so far. But what does all of this mean to our economy, our investments, our day-to-day lives? And some of the things that are important to look at is when we look at the economy, for instance, we went through an experience of what I would call a roller coaster ride in 2020, and the roller coaster has continued in 2021 for that matter. We had record high job losses of over 20 million job losses in April alone of last year. That was followed by, in the next 6 months, 11 million jobs created, jobs added back in. And that was, at the same time that drove our unemployment to almost 15% unemployment, which is staggering and was record-breaking at that point. And since then, it's dropped off to 6+% now, and where we sit now, we have, we had record low GDP in the second quarter of 2020 with a minus 31.4%. I mean, that's kind of staggering when you think about it. But that was followed by an increase of over 33% in the third quarter of 2020. And, the consumer spending, we saw everyone tighten up their wallets and close their wallets, quite frankly, and saw a drop of $2.4 trillion in consumer spending in March and April of last year. And 2 months later, we had regained about 75% of that. So this has been a true roller coaster ride for the economy, and it has been for our investments as well. When we look at the investments, the S&P 500 for the year of 2020 actually returned just under 16%. And that's even higher if you count the dividends that were distributed. But however, if we remove the top 25 holdings out of the S&P 500, the remaining 475 investments only gained under 5%. And meanwhile, approximately 40% of the overall stocks in the S&P 500, or 198 of them, actually had negative returns for the year. So it's been a very uneven distribution of the benefits and the losses for this past year. And when we turn to our daily lives, we learned a whole new language. We learned new vocabulary, wear masks, wear two, maybe three. And social distance, we learned words like comorbidities and herd immunity and at-risk populations and so on and so forth. And, all of this was out of, quote, an abundance of caution. And some of you may feel that not enough has been done or said, and others may feel that they've been constantly berated and far too much was done. But the single common factor out of everything that we've experienced in the last 12 months has been that no one feels normal. And so if we take back a look in history, and to kind of put some of this in perspective, maybe, especially on the political front, over the last 100 years, who did control the Senate, the House, and the presidency? Well, 34 years of that 100, or a third of the time, it was controlled solely by Democrats. Another 18 years, or almost 20% of the time, the Republicans had sole control. And the rest of it, almost half of the last 100 years, has been a very divided Congress and Senate and presidency. And as a result, that's been the predominant period that we've lived in, has been when it was divided one way or the other. And if we look at the specifics of when those occurred, a lot of that has occurred even early on, under Truman and FDR and under Harding and Coolidge and Hoover and that type of thing. But we've seen more lately where it's flip-flop back and forth. And I'm going to show you next one of my favorite charts, because this chart tracks where, we had a Democratic president, a Republican president, Democratic Senate, and so on and so forth. And when it's split. And if you look at this, so what does it tell you? If you look at all of this chart, what does it tell you? Nothing. It tells you absolutely nothing in terms of the influence of the political party on the average annual returns. Now, that's not to say that things that occur in the legislature, things that occur in the presidency, don't affect the markets. They can, and they do. But in terms of the longer term view and the average annual return, political party in a particular office doesn't dictate whether things are going to be good or bad. And so let's take a look at what some of the market expectations are, and you know, what's new and what's not.
So here are some of the items that the Biden administration would like to implement. You know, I'll try to focus on just 3 of these. The first is the Biden Rescue Plan. So this is the plan that's been in the news over the last few weeks. The Biden administration would like to put in a stimulus package of $1.9 trillion to try to help our economy stay afloat until we reopen our economy. If we look at the stimulus packages that have been implemented in the last year since the pandemic started, if this goes through, we would be at $5 trillion in dollars that have been spent to try to keep our economy going as we try to reopen. So what would be included in this Biden Rescue Plan? For individuals making $75,000 or less, or married couples filing jointly making $150,000 or less, they would get an additional check of $1,400. The supplemental unemployment benefits would be increased to $400. Currently, they're at $300. The big difference, though, is that in the plan that was put in place in December, it was supposed to end in March. What the Biden administration is proposing is to keep these until September. They want to give $350 billion to state and local governments to help them be able to keep all their public employees employed, like teachers, police force, etc. They want to spend $170 billion for K-12 schools to reopen our schools and keep our students and faculty safe. There's a plan to spend $70 billion for a national vaccine and testing program, and they want to fund 100,000 public healthcare workers to vaccinate the U.S. population. And lastly, they want to spend $15 billion to help our small businesses over the upcoming months. This would be in addition to the PPP plan that was put in place in the spring. So how do our portfolio managers look at these stimulus dollars that are put into our economy and how they can take advantage of that when they look at companies that are going to invest in? One of our fund managers that invests more in a theme basis, one of the themes that he added last quarter was a live mobility theme. And what that means is he believes that there's a lot of pent-up demand by the consumers. If you looked over the last 7 to 9 months, the U.S. consumer has reduced the amount of debt that they hold. They've increased the amount of spending. They've been in lockdown for 9 months, and they're looking to reopen the economy and be able to benefit from that. So to be able to travel, to be able to go out to bars and restaurants, and they have money to spend. So the anticipation is that when the economy gets going, there's going to be a lot of money injected into the economy to benefit from this mobility. And this manager is going to look at these companies that he feels that when this happens can take advantage of this. Secondly, the trade war that we've had with China over the last few years, I think the consensus is that the relationship will stay strained for a few years. Now, you know, the belief is that it might not be as strained as it was, but there's going to be a strained relationship, no doubt, because I think the consensus is that China has done things that are probably not kosher. So how do our fund managers that invest internationally view this, and if they see this as an opportunity or as something that might be dangerous? One of our fund managers, he believes that he's really bullish on international investing moving forward. He believes that there's a lot more growth that will happen when the economy is open internationally than domestically. he believes that this will cause our U.S. dollars to go down. But how they try to mitigate the potential trade war, he strongly believes that the Chinese government is going to accelerate their goal to have a lot of the economy, the goods produced by local companies. So what our portfolio manager will do and has been doing over the last few months, he's investing in Chinese companies that serve the Chinese market instead of companies that serve the Chinese market but also have a big percentage of their revenues coming from exports to foreign countries. So what that means is that they will be less likely to be affected by tariffs if there's a trade war that keeps going on. So they're going to be isolated from that. And he also likes the fact that the Chinese are probably a few months ahead of us in reopening their economy. They've been open now for a few months, so they're taking advantage of an economy that's running on full cylinders right now. So that's how he is trying to take advantage of this trade situation and benefit our clients that are invested in his portfolio. Lastly, I want to look at the Biden recovery plan. The difference between the recovery plan and the rescue plan is the rescue plan, it's money that's going to be injected in the economy to kind of bring us to a period where our economy can reopen, where we have herd immunity. The recovery plan, it's kind of Biden's goals that he set up when he was running for office on what the areas of the economy that he really wants to put an emphasis on to create growth, job opportunities for the U.S. So the three areas are on this slide. The first is infrastructure. He has a goal of spending $1.3 trillion over the next 10 years to kind of refurbish our infrastructure and bring them to the 21st century. Secondly, they have a goal to spend $2 trillion on the environment, the clean energy areas of the economy. He wants the U.S. companies to become leaders worldwide in this area. And lastly, he set a goal that within the next 10 years, he wants 97% healthcare coverage for all U.S. citizens. So now the next slide is now that we've kind of identified the areas that the administration wants to spend the money, how are they going to pay for these expenses? So I'm going to look first at how this will affect individuals when he looks at sources of potential revenues for the U.S. government. So the first thing that Biden wants to implement, he wants to increase the top individual tax rate back to 39.6. That was the rate that we had prior to the last Trump cuts a few years ago. Secondly, he wants to make a significant change to people that have money in the market. So long-term capital gains and qualified dividends, he wants to tax at ordinary rates. Currently, you will be taxed on these elements at either 0, 15, or 20%, and it's going to be based on your top marginal tax rate. So for those that have income generating from the markets, this will cause a pretty significant increase in taxes to these people. Lastly, at the individual level, he's making a significant change in philosophy when it comes to deductions. He wants the deductions to have the same benefit for everybody, and he'll do that in the form of a tax credit versus just taking a deduction from your income. So for example, if you participate in a 401k plan and make a contribution of $10,000, what Biden is proposing is to give you a tax credit of $2,600, which would be 26% of the $10,000 that you deducted. In the past, you would deduct the $10,000 from your income, and the amount of dollars that you would be saving would be based on your tax rate. So if you were paying taxes at an amount higher than 26%, you would be at a disadvantage compared to what Biden is proposing. If your tax rate was lower than 26%, you'd benefit from it. But I think his big philosophy change is that he wants the deduction to have the same dollar savings for everybody. At the corporate level, if we go back prior to the Trump tax cuts, the corporations in the U.S. paid a 35% tax rate, and that was one of the highest tax rates for corporations in the world. I think there was a consensus that that was too high, and what was happening is we had some of our domestic companies that were moving their headquarters to foreign nations to take advantage of the lower tax rates. So Trump had reduced the tax rates from 35 to 21, and what Biden is proposing is, I think he agrees that the tax rate of 35 was too high, but he believes that the corporations have had too big of an advantage, and he wants to bring the tax rates back up to 28, which would be the midpoint from where Trump ended up and where they were originally. The second big change is he wants to be sure that each corporations pay their fair share of taxes. So he wants to implement a 15% minimum tax rate on any profitable company, and he defines a profitable company as a company that has a book profit of $100 million or more. So those are the big changes on the corporate side. If we look at the Social Security, he does not want to implement any changes for anybody with incomes of $400,000 or less. But if your income level is above $400,000, he will bring back the tax rate on Social Security for every dollar above $400,000. You will pay a tax of 6.2% on that additional incremental income above $400,000, and half of that will be paid by you, and half will be paid by your employer. Lastly, on the estate side, the big change is presently the estate tax exemption is at 11.87%, $11.87 million, and he wants to reduce that to $5 million. So those are the big changes in the tax proposals. Now I want to take a few slides to, can we turn this slide? I want to take a few slides to look at the Secure Act that was implemented last year. One of the biggest changes to last year's Secure Act was the elimination of the stretch rules on inherited IRAs from non-spouses. So what that means is if you inherited an IRA, for example, from your father, in the past, you could take a distribution from that IRA over your life expectancy. With the new rules, you're going to be limited to take a distribution over a maximum period of 10 years. So for example, if you're 50 years old and you inherited an IRA from your father that has $30,000 and you have an expectancy of 30 years, you would have to spend that $30,000 over the next 30 years. With the new rules, you have 10 years to take the distributions from that $30,000. And the reason that the changes were made is just that the federal government wants to get their taxes sooner rather than later. What that will mean is, from a tax planning point of view, if you have an intention to retire within the next 5 to 6 years, it might make sense to delay the distributions until after you retire. So this is a great opportunity for you to talk to your wealth manager, to talk to your CPA if you've inherited an IRA, and to look at the timing of when should we take distributions to minimize the tax impact on you. If you've inherited a Roth IRA, there might be an advantage, again, after you've talked to your wealth manager and to your CPA, to delay the distribution as long as possible and let that money keep growing tax-free for the first 9 years. I'll also discuss a point. If part of your planning when you talk to your state attorney and your CPA and your wealth manager was to have the beneficiary of the IRA be a trust, you should talk to those people, because with the change in the number of years where you can take a distribution, it's going to be important that the language in your trust is such that you can take the money out within the first 10 years, because trusts are taxed at the top marginal rate at a much lower income level, so it's just below $13,000. So you don't want to be in a position where you thought that your planning was such that you would pay less taxes, and because of the language in your trust, you're paying more taxes. So I would highly recommend you talk to your wealth manager, the state attorney, and CPA to be sure that your strategy is still the best way to go moving forward. We'll look at RMDs because the RMDs got affected with the Secure Act, and with last year we having the option not to take any RMDs, this might not be as fresh. So one of the big changes that was put in the Secure Act is if you turn 70 and a half after December 31st of 2019, your earliest age that you have to take RMDs was moved from 70 and a half to 72 years old. So there's going to be a strategy here for the first payment. You're allowed to go until the year after you turn 72, up until April 1st to take the first payment. But if you do that first year, you'd make 2 payments. So there's going to be a strategy, again, to discuss with your wealth manager and your CPA. If you're better off to take your first distribution the year you turn 72, and then take another one the year you're 73, or are you better off not to take a distribution the year you turn 72? Delay it as long as possible to April 1st, but if you do that second year, you'll have 2 distributions. You'll have your first year distribution that you delayed, and then you'll have your second distribution you have to take by December 31st. And then from a strategy point of view, I want to talk about the qualified charitable distribution. So what that is for people that are charitably inclined. You can take your RMDs and pay the amount directly from your IRA to the charity. And you can take anywhere between 1% to 100% of the RMD and pay it directly to the charity. The advantage of doing this is that the RMD that you've taken and paid directly to the charity will not be included in your income. In the past, if you don't do the qualified distribution, and you would take the RMD, and then once you've taken the RMD, make a contribution to the charity. In the past, what that would have meant is you would have had an income of the amount of your RMD, and then you'd have a charitable deduction in your itemized deduction. But with the new tax rules that were put in place by Trump, where they increased significantly the standard deduction, less and less people take itemized deductions. So by making the payment directly through the charity and not having the income included in your tax return, you could pay less taxes by doing it this way. So now we're going to look at the economic impacts of everything that's happening with the reopening of the economy and the stimulus packages that have been put in place. I think the highlights are that in 2021, we should see above normal GDP growth. The companies that are in the clean energy, climate change, environment areas should benefit from these expenses that the government wants to put in place. We also see that with what happened in the last few months, there's kind of a will by both parties to put more regulations on tech companies. If extra regulations are put in place, there's going to be expenses for these tech companies, and this could impact the bottom line for them. So it's going to be important to see how that gets affected. And our portfolio managers are going to be looking at this when they're looking at either staying invested in tech companies or making future investments in tech companies, and the risk of regulation and how that's going to impact their businesses. And lastly, I want to talk a little bit about inflation. I think inflation is going to be the wild card. I think it's clear that we anticipate that inflation should increase in 2021 as our economy reopens with all this pent-up demand. I think where we have some uncertainty, it's on the longer term period. Are we going to continue to see inflation going up, or is inflation going to stay in the 2% range? And if inflation goes up, this could create some havoc on our economy. And Marla is going to be talking about this in a little bit more detail a little bit later. So what are the impacts short-term and long-term? Short-term, I think the three items that I want to discuss is that I think there's a consensus that by third quarter, the economy should be fully reopened, and we should see high GDP growth, anywhere between 6 to 11%. With the stimulus money that's been put into the economy and will be put in the upcoming weeks in the economy, and with the pent-up demand of people having a lot of savings when the economy reopens, we anticipate to see higher inflation. With the stimulus packages, we've seen our debt increase, so that's going to be something to monitor. So that's the impact short term. Long term, we anticipate that the GDP growth is going to come back to a more normal range of 2 to 4%. We could see higher inflation caused by this government spending that seems to be just keep going higher and higher. And if the momentum continues where we see less globalization and see more people spending within their borders, that could also cause extra inflation. We anticipate a return to full employment. We had that before the pandemic, so we could see that continuing. And lastly, there's a belief that if we continue deficit spending like we've been doing in the last few years, that will just cause our debt to continue to increase. So now we'll turn things over to Marla.
So thanks, Francois. And let's talk a little bit about debt. And, you know, debt in and of itself is not good, bad, or ugly, but it can be all of those. And when we look at debt, and especially if you look at it not just from a national level, but kind of related to a personal level, you know, the good part about debt and the good uses of debt, so our annual output growth rate has maintained, and as long as it's maintained at above 3%, we are able to continue to grow. And as with interest rates low, then it makes sense to take on debt. Good example on a personal level is a mortgage. You know, 50 years ago, they used to feel that you needed to save in order to buy a house until you could afford a house. And then mortgages became very popular, and we ended up borrowing to finance our homes. Right now, mortgage rates are extremely low. And so it can be good debt as long as the growth rate is above the amount that you're paying on the interest. So, and the interest payments, interestingly enough, on our national debt, although our national debt has been higher than it ever was before, the 2020 interest payments actually declined from 2019, and that had a lot to do with the interest rates being down at zero. Now, on the bad side of debt, ongoing deficit spending will, you know, if that outpaces growth, then we can't keep up, and we have ongoing increases in the amount of debt, as well as ending up pushing rising interest rates. And as a result, then we're going to spend much more on the interest payments. We are going to have much more debt. And that's kind of a little bit of a vicious circle or cycle that you get into that then can turn ugly. And the way it turns ugly is really if Congress, based on what they've been doing for the last year and probably well into this year, where there has been this ongoing spending, and it's been purposeful spending to try and raise the economy and keep the economy out of a recession. And in order to do that, they've been spending. And if they become addicted to that spending, and we can always fix something else by spending, and the deficit spending keeps rising, that can be a real problem. And it will ultimately, we can see accelerating interest payments, and especially if we see rises in inflation, as Francois talked about, that if we see those rises in inflation, then we can very well start to see the interest rate starting to be ratcheted up. And as a result, those interest payments will accelerate even further. And so when you think about just debt and the other things that we've talked about here with the economy and overall your investments, what kinds of things should you be looking at to maybe give you a sense of where we're headed? Because none of us has a really good crystal ball to just say, here's what's going to happen in next June, and here's what's going to happen by December. But there are indicators out there, and three of them that on here that I'd like to talk about are first of all, the weekly manufacturing hours and how those influence the weekly unemployment claims. So one of the first things that happens when a company's orders or anything start to decline is they will start cutting hours. You no longer have overtime. They may even cut somebody that's a 30-hour worker to a 20-hour worker, that type of thing. And so you will see cuts in weekly manufacturing hours very early on. And ultimately, those will turn into, well, I need to give you a pink slip, and those will turn into unemployment claims. Similar, the goods, and especially goods orders, especially durable goods, which are larger things, the appliances, vehicles, those kinds of things, we start to see if consumer expectations start to turn negative, then those are some of the first things that stop being purchased. For instance, think of your own household. If hours get cut, for your family, or one of the family members loses their job or is just laid off temporarily, then that's probably not the time you're going to go out and buy that new refrigerator. And so those types of purchases end up being delayed. Finally, building permits is a very good harbinger of things to come, because building permits need to be pulled from the counties well in advance of anything coming online as a building, whether it's a commercial building or a residential building. All of those, the permits are pulled way in advance and are significantly influenced by the interest rate spreads. If interest rates start to climb, building permits are one of the first indicators that that's a problem, because the builders, whether it's commercial or residential, where they get their money is to borrow it. They don't necessarily put their own money out there up front. They borrow money at lower interest rates, and that's why you've seen tremendous building right now happening. And when we start to see building permits level out and or decline, that will be an indicator of that the economy may be starting to contract or slow down. And in terms of the things that you'll hear about, whether it's on CNBC or just the nightly news and snippets about the economy, these are five of the terms that are pretty commonly reported on in most media. And the things to look for is GDP growth. As I mentioned earlier, it's 3%. If we get above 3%, and clearly, as Francois mentioned earlier, in the 6 to 11 range, that is huge for growing the economy and stimulating job growth. And so as a result, you will see unemployment figures drop possibly below 5%. Typically, economists consider 5% to be the full employment range, between 4 and 5%. And the other thing that you may hear about is inventories, that inventories start to build up, or that inventories have declined. And that moves inversely to sales, because think about it, if you're running a business and you're selling widgets and everybody's buying widgets, and as fast as you can make them, they're going out the door. When your orders start to slow down, you're still producing at the same level, and all of a sudden then you have to put some of those on the shelf, and those become inventory. And as it slows more and more, those will accumulate. Likewise, if it all of a sudden speeds up, you decrease your inventory and sell everything that's on the shelf just to keep up. And that's where you have delays in delivery, the things that we've seen more recently. Retail sales, as I mentioned earlier, that typically tracks with consumer confidence. People need to be confident, that things are okay before I open my wallet and start spending. And housing starts, I talked about the building permits, and those are generally move also inversely with interest rates and unemployment. Because, for instance, housing starts, I'm not going to go out and buy a new house if the interest rates are high or somebody in my household has just recently lost their job. So those tend to track with each other and are pretty good indicators one way or the other. So what have we learned from history of the economy and investing, and how to recognize what's happening? Well, the important thing is that nothing stays the same. The most constant thing in our history is that nothing stays the same. And that's why this country has made so much progress going forward, is because nothing has stayed the same. And secondly, your perspective matters. And I don't know if anybody's seen, there's an ad on TV that shows somebody reaching to grab this woman's purse on the street corner, and grabs it, and it appears that he's about to steal it from her. And then they show it from another perspective, and he's grabbing her purse because that's the only thing he can grab onto to keep her from going into the street, because there's an oncoming truck, and he's trying to stop her. And it's one of the best examples I've seen of how perspective matters, and especially as we look at what has happened in the political arena and the investing arena. It all depends on where you're sitting, how you feel about those things, and acknowledging that other people see things differently, but that doesn't make it wrong. And what's important is that we don't overreact to things, because overreaction rarely helps. And if we can take from that just communicating to each other and your advisors, all of the people in your lives that are important, that communication will help us a lot. And finally, we can learn a lot from this pandemic and what we've experienced in the last year. But if we don't learn from it, we're kind of, as history would tell us, we're doomed to repeat it. So I'm going to turn it over to Francois to talk a little bit about where our philosophy is on the investment side and going forward in 2021.
So we're going to finish with our investment philosophy. I think at its core, our philosophy hasn't changed. I think that, the one thing I want to reiterate, it's the importance of having a long-term time frame. The importance of having a long-term time frame is that you really reduce the volatility of the returns in your portfolio. I think when you look at the short term, and I think we had the perfect example in 2020, it's almost impossible to predict what will happen short term. We lived through an unbelievably bearish market in March, and then in April we probably had the strongest bull market that we've ever had. So for those of us that didn't stay invested and got scared in March, well, you lost out on a great opportunity. So to try to determine what will happen short term, it's almost impossible. But with the long-term time frame, I think it's clear that the volatility gets reduced. And if you look at history, you will make positive returns over the long term if you stay invested. So what were some of the changes that we incorporated to our portfolios moving forward? The first change that we did, we were over-allocated to value, and we decided to bring our portfolios more into balance when it comes to value versus growth strategy. Over the last 10 years, growth has outperformed value. So some of you might ask, well, why don't we over-allocate the growth? And I think our belief would be that, after a 10-year of overperformance, this is not the time to over-allocate the growth. And also, value is due to do better than growth. And if we go through a period of higher inflation, that should really benefit value managers. So we really feel comfortable from a diversification position also that to be balanced between value and growth, we will put our clients in a position to benefit the most from whatever can happen moving forward. Secondly, on the equity side of our portfolios, we've increased our allocation to international exposure in companies. The reason for this is twofold. First, from a valuation point of view, international companies are priced at probably the biggest discount that we've seen in 30 years compared to U.S. companies. Secondly, I talked about this a little earlier, but if the U.S. dollar is predicted to lose some value, this will really benefit international markets and international companies being in international dollars and currencies. So that's the second change that we made to our portfolio. Third, we also added 2 small cap funds to our portfolio. We added a value manager and a growth manager here. And from a diversification point of view, we've incorporated kind of a second layer. One of our partners, which is Athena, they use a patented strategy to classify portfolio managers that rely on looking at the prospectus and seeing how the portfolio managers define their strategy when it comes to investing. And Athena divides them into 10 categories. So some of the categories are future growth, competitive position, and they can have risk, ESG. And what we try to do, especially when we added some funds this year, it's to make sure that if we were hesitating between 2 funds, that we looked at the strategy as defined by Athena to make sure that we were diversified amongst our fund managers to bring less volatility to our returns moving forward. Because if we're diversified by strategy, we believe the ride will be less volatile and we'll be in a position to bring the best returns to our clients. Lastly, we tried to simplify the name of our models when it came to our equity sleeves. So now we've created a US sleeve, an international sleeve. We still have a tactical sleeve with Athena Global Tactical. And we've added a theme sleeve. We call it our global theme. So those are the changes that we've made. We feel very confident that our clients are in a great position moving forward. We're excited about the prospect of investing in this economy as it opens up. We're glad that you decided to be part of this presentation. If you have any questions, I would highly recommend that you talk to your wealth manager. And I don't know if Marla, you have anything to add? Thank you.
No, but I would, as I mentioned earlier, I would highly encourage communication at this time. And so, and questions do arise, or you hear something on the news, or your neighbor says something, call your wealth manager, call your CPA, call your estate attorney, whatever that question relates to, because communication really is the key to this. And there's a lot of people that can give you, additional information and perspective. And so I'll turn it over to Bret to close us out.
Great. Well, you guys, great job. Thank you very much. You went into some A lot of details there that I think that our listeners and our viewers are going to really appreciate. As you guys have said, I think that the type of information we've discussed here is going to create some questions. And again, calling your wealth manager makes a lot of sense. We can help maybe ease some of your fears or answer any just kind of curious questions that you might have regarding this information. So with that, as one of the partners of the firm, I'm going to turn it off now, and we'll see you guys on our next Lunch and Learn that we do virtually. Take care and have a great time going forward. We'll see you. Bye-bye.